Today, we are privileged to have Mr. Ken Johnson, who is a Vice President of Loomis Sayles and Company and Product Manager for the Loomis Sayles Full Discretion team. He joined Loomis Sayles in year 2000 as a fixed income client portfolio manager. Prior to Loomis Sayles, he worked for the Investment Counselors Incorporated, where he was responsible for business development, client service, and consultant relations. What are your views on the current interest rate environment? Will the US Fed Reserve hike rates in the near future?
I think we are back to a lower for longer interest rate environment. In addition to slower global growth and low inflation, I will point to two recent developments that lend support to that view. One is the recent outcome from the Brexit referendum. And then the second, I will point to the 1.2% second quarter GDP growth in the U.S. I would say the Federal Reserve is likely to remain on hold until December of this year at the earliest.
Could you comment on the divergences in monetary policies between the U.S. and the rest of the world?
I think there's less policy divergence priced into the market today than, say, last year at this time. I don't think the Fed is likely to reverse course and start easing interest rate policy, but there's certainly no urgency to begin hiking rates, given the current inflation in the global markets. And I don't think the Fed is looking to add pressure to already strong deflationary conditions.
Will the Fed reverse its tightening policies and start easing again?
I think there's less policy divergence priced in today, given that the Fed is on hold and central banks around the world continue to remain inaccommodative. Coming into the year, the market was pricing in more Fed hikes, so there was greater policy divergence. Given recent economic developments in the U.S., given the global uncertainty that continues to compound, I think the Fed now is looking to move more gradually. And so the market is beginning to price in delays in hiking rates.
How likely is helicopter money going to be in Japan or any other countries?
I would say it's possible, but not likely that you see helicopter money as a policy tool. Historically, helicopter money has come with some very extreme risk. For example, hyperinflation is a situation that can develop as a result of helicopter money, a situation that we've seen historically and we're seeing today in Venezuela, for example, where the IMF is projecting inflation could be 480% this year. So I think the Bank of Japan is less likely to use helicopter money as a policy tool. Instead, probably take the approach of some new fiscal stimulus combined with some additional quantitative easing to achieve some soft form of helicopter money. In any event, I'm sure central banks around the world, including Europe and the U.S., will be taking note to whatever approach the BOJ takes for signals of how to deal with the next downturn in the economic cycle.
How is the fund managing interest rate risk?
Our duration right now is about 1.5 years short of the index. We have been taking more credit risk, less interest rate risk, in our fund. We have been using 1 to 2 year treasuries for reserve type purposes, in the portfolio. So we're taking less interest rate risk with the expectation that, the economy will continue to grow at a steady but slow pace. So we've been taking more credit risk in the portfolio.
How important is credit risk now? Can you walk us through the fund's credit selection process?
Sure. Relative value drives our credit selection process. We're really focused on security-specific risk in this environment. So we're looking for issues with improving credit profiles. We rely very heavily on our research capabilities to identify specific security-specific opportunities, specifically opportunities where the credit profile is improving on a 1.5 year outlook basis.
Do you only look at external credit rating or do you have an internal scorecard?
Sure, we're aware of the credit rating agencies, and we do factor that into our decision process. But our process really relies heavily on our proprietary rating system that dates back a number of years. And so we will assign an internal rating to every credit that goes into our funds and portfolios.
And lastly, with yield trending lower, many funds are going down the credit curve in search for higher yield. How does the fund maintain a reasonable yield without sacrificing its credit rating?
Sure. We have a healthy yield advantage to the broader market indices today, and we're taking steps to build and maintain that, not by chasing yield and going too far down in quality, but instead we're looking across the capital structure for opportunities that offer upside without the same amount of downside risk. For example, we'll use the convertible sector as a substitute for CCC rated high yield debt, where we can capture some of the upside potential with less downside risk. Well, right, one of the ways we'll look to maintain some yield in the portfolio. So we have a yield advantage now, and we're taking steps to maintain that yield advantage, but without going too far down in credit quality. Instead, we would be willing to look down the capital structure and get exposure to other parts of the capital structure versus getting lower rated debt.
Thank you, Mr. Ken Johnson, for your insights today. For more information, please visit our website at poems.com.sg/unittrust or talk to us at 65311 555.